Hello, this is Bill Moreland with BankReg Data. Today I'm going to spend a little bit of time walking through Flagstar Bank. It's former New York Community Bank, bought Flagstar, and then later, real quickly, they ended up acquiring Signature Bank's assets. I don't get into the business of failure, not failure, buy a stock, sell a stock. That's not, you don't want to be taking advice from me. But if there was one bank that was large that looks like they're having some serious issues, it's Flagstar. So first thing is, I always find it interesting looking at their main page. You can tell a lot about what a bank's currently going through by just looking whether or not it's pushing CDs and money market. You think we're past the liquidity, right? This was a big thing for last year and a half, but right here on their flash, we can see that they're still pushing CDs, right? They're still trying to get some liquidity and some funding into the organization. So let's go ahead and close that down. Here's the Flagstar institution, and here you see the acquisition from New York Community Bank to Flagstar, and then Flagstar to Signature, and then they rebrand as Flagstar. A couple things to note is essentially they've gone from 8,766 employees to 8,300. They are also going to lose about another 1,200 with the sale to Mr. Cooper of their mortgage banking activity or their mortgage servicing organization. That is going to essentially raise about 1.3 billion in cash. So we're pushing funding, we're selling assets to get cash, shrinking the bank to focus. We'll get into a lot of these metrics, but we'll just push down here to our tear sheet, and we see that orange is going to be in the bottom 20% nationally. Blue is in the top 20%, top 50%, excuse me. So what we're seeing here is a lot of orange and asset quality, and that'll be where we spend the bulk of our time. We'll also take a look at a little bit of their capitalization. Some liquidity issues right here. One is not cash. They got a lot of cash, and obviously they're raising even more. But essentially their loans to core is very high. Their core deposits is very low. So you can see there is some liquidity things that they're trying to deal with. If we scroll down a little bit more, let's go down to our threshold alerts. These are 88 metrics down here at the bottom. And this is probably one of the longer lists. If not, I should look. It's probably the longest list of items among any big bank. These are 88 metrics, and what we're looking for are things for major that are in the bottom 7-10% nationally compared to other banks. The minor alerts are going to be in the 7 to 15, 7 to 16% range. So we can see the CRE concentration ratio is still very high. NPLs, non-owner NPLs, 1 to 4 NPLs, non-performing assets, multifamily NPLs, and then we see a lot of liquidity. Federal Home Loan Bank advances are very high, core deposits are low, loans to core, brokered's high. Probably the one that's going to be the most topic worthy of a discussion is the coverage ratio at 47 cents. That means they have only 47 cents of reserve set aside for every dollar of NPLs that are potentially going to hit their income statement and charge-offs. Scrolling back up, we look at our Sentry event engine, and what we should really do here is cycle over to Sentry proper, right? That was the summary. This is the detail. And so we can see that their multifamily loans are up 710 million in the quarter on NPLs. So we've basically gone from 32 million to 60 million to 300 million. Hey, it's only 2 charge-offs. That's what they told everybody, right? 100 million in charge-offs about a year ago. But as we can see, those multifamily NPLs are alarmingly go up every single quarter. And we're essentially seeing the same thing, almost the exact same chart in non-owner occupied. So 22 million to 140, 114, 270, 750, 800. 1 to 4 firsts, still fairly elevated, but about the same. First early stage, the scale's a little bit adjusted here, but we see that number's up 48 million. Let's go take a look at the other. And so a couple things we see here. They are trying desperately to raise core deposits. That number is acquisition based right there. It's been coming down and then has since been going back up, which makes sense given the fact that we're seeing that they're pushing that on their splash page. But if we cycle in here, we see that they're trying to sell a lot of non-performing notes. We can see the loan sales right there. So they're trying to change that loan book. So let's take a quick and see how. Let's take a look to see how successful, and we know that there's still a lot on the books. We're going to go to Bank Home. We're going to go to Tier 1 Capital. And so as we scroll backwards in time, prior to the acquisitions, New York Community Bank, for the most part, was very well capitalized. But we see that that number has been coming down. Now, just as a reminder, this is regulatory data. This is going to be what's at the depository level. So any capital or income setting outside the depository is not going to be reflected on the call report. But this is a good idea what the banking franchise proper is doing. So we see that essentially got a couple things going on here. Post-acquisition, we see 9.7 billion, 9.3, 9.4, 9.2, 9 billion. They're shrinking capital. They're losing capital. So once again, as a reminder, when a bank starts getting with a 10 handle, you rarely see that. You rarely see a bank, any bank, but especially the biggest ones, get down around 10%. So they were dipped below 11 at 10.84. They're still losing capital, but notice essentially how the risk-weighted assets dropped from 85 billion to 75 billion. And the reason for that, primarily, is they sold a whole bunch of notes. And we can see that simply right here. This is their total outstanding loans. If I get an exact copy of this, bring it over here, go back Bank Home, go look at loans held for sale. I can see right here they started basically putting a lot out there. Now, loans held for sale is just a catch-all, but we can take what's on schedule RCP, which is mortgage banking activity, which that unit they just sold, right? They just sold that to Mr. Cooper earlier this month. But non-mortgage banking activity, they went, up to $6.4 billion. So they're selling notes. The other way to see the impact is go to income and expense, non-interest income, gains, losses from loan sales. So prior to the acquisitions or during the that initial time frame, there was some note sales, and then it kind of scaled. This will also include mortgage banking activity. But when you see that big negative, that means they're selling notes at a loss, and they're having to take that charge off. So let's come back over here and look at the loans, and we'll go ahead and shrink this one down. So as you get a shrinking denominator, understand you could get percentages like NPLs or delinquencies or modifications that go up. So we do see an increase in delinquencies. So what we're going to do is break these down by non-performing loans. And it isn't just a shrinking denominator, right? We're seeing actually a very big increase. 760, 950, 1.2, 2.5, 3.7. That number is starting to accelerate quite aggressively. You do see a shrinking denominator right there from the 82 to 73. So that's going to make the percentage be more alarming. But understand, until you start to see those non-performing dollar amounts get smaller quarter over quarter consistently, we have to make the assumption that this bank is going to continue to have more delinquencies that they're going to have to deal with. If we scroll down, this is the non-performing loan rate by portfolio. And that's 4.28% on their largest portfolio, which is multifamily. Their C&I is 2.3, 9.3, 12.6. So let's just start cycling through this. Century showed this on some of these portfolios earlier, right? That kind of hockey stick acceleration. C&I, that one peaked a couple of quarters ago. It's still elevated. Non-owner occupied. All right, so that number's going very high. The 1 to 4 family first liens. Now this one's always a challenge. And the reason for that is government guaranteed loans, otherwise known as taxpayer funded elevated housing prices. What you have to look at is how much of it is non-accrual and how much of it is 90 days past due. The fact that they don't have any of it on 90 days past due leads me to believe that they probably don't have much in terms of government guarantees. So I'll go into asset quality, I'll come into government guarantees, and actually they do. Kudos to them. This is actually rare. So these are delinquencies. You see 571 million is on non-accrual. You come over here. So 571 of that 671 is actually government guaranteed. What's unique about Flagstar is almost all banks will not have that on non-accrual at this stage of the game. They will be putting that on 90 days past due accruing fee and interest income. That is actually very rare. What that means is any payments that come in will be going to principal pay down rather than bank income, late fees, and interest income. So they do have a lot of elevated. So you have to ask yourself, why do we have a lot of elevated mortgages in the best housing market of all time? But that's a whole nother video. So that portfolio isn't necessarily going to be one they're responsible for, but the non-owner, the multifamily, and the C&I most definitely. But as we start to cycle through here, we're seeing other portfolios have problems as well. So we had nothing in construction, and then it jumped to 16, and it jumped to 30. And so that real quickly is problematic for them. Leasing, same thing. So what you're getting with Flagstar is a series of cascading problems in multiple portfolios early, and now later, recently, we're getting secondary and tertiary portfolios starting to have same problems. So to think that this is a one-off or it's going to go away is I still think we're on the upside of this. Are they playing extend and pretend? These are loan modifications. Performing means that these don't sit on the delinquencies. So if we come over here and we look, at their delinquencies on the multifamily portfolio, it's 1.6 billion, 4.64%. The performing mods aren't included in that number. So they're really sitting at 1.7 billion of issues. The only other portfolio we see that they're doing that in is 1 to 4, which begs the question, are we modifying government guaranteed mortgages? Yeah, we are in big time. But the non-owner portfolio. And so at one point, the non-owner, started to have a lot of performing mods. But what's happening is it looks like they're probably selling those guys off, or they're recidivists and going back into delinquency and moving over to non-accrual. So we're seeing that they are not totally playing the extend and pretend game. They still are on some multifamily, but mostly they are recognizing the loans that are problematic, and you can see them very clear. You don't have to go digging around for it. What is the biggest issue that I have with this bank, however, and why I think it's going to be struggling, is that's the allowance ratio, right? And so allowance to reserves, realistically, you back out the held for sale, especially if that big mortgage banking activity. This is a really difficult ratio to look at because it really depends upon the loan mix. And so I tend to say yes, look at it, but realistically, the number that I focus on most is the coverage ratio. And so what this does is it says, for every dollar of NPLs a year and a half ago, Flagstar had $2.53 of reserves. So they're still red. They're still below peers at 3. So you can see almost 2 years ago, they were in line with the other large banks, $3.38. But every quarter, we see that number coming down. And the fact that it's sitting at 47 basis points is surprising. I mean, it's extremely low. I mean, very low. Beal never counts. There's Merchants Bank of Indiana, which I've already had a discussion about. If we adjust it for TDR, we see the number drops even further to 44 cents. So this bank is not reserved, not even close. I mean, we're basically backing out all guarantees. They have $2.85 billion of NPLs. And modified loans that are essentially climbing $1 billion to $700 million a quarter. So once again, if you see the trend going like this, the question is are we peaking and rolling over, or do we anticipate that we're still going to have problems? In the current macroeconomic environment, I'm hesitant to think that this number is just going to magically peak today and get better tomorrow. The only other thing that I wanted to talk about was the crazy levels of cash. So they're sitting at 20%. So if I go into cash, this is a big liquidity thing, right? And they're selling a lot. They're selling a lot of stuff. So cash keeps going up. And it's all sitting at the Fed, right? And so they're generating a very good amount of income from this. So the backdrop to this is that sustainable when the Fed is dropping rates? So there's your $22 billion. If I come over to yield, which is interest income, and I look at balances due, this is going to fluctuate, but you'll notice it's pretty close. The average balances due are 14, 17.8, 23, because it's a 2-quarter average. On the left, you see 12, 18, 22 and a half. So this is what they're earning, right? This is what they're earning from the Fed, which is 540 basis points. Well, we know that number is coming down significantly, and it will continue to come down. And the reason the Fed lowers rates is banks got to start taking losses. And the easiest way for banks to start taking losses is to lower their single biggest expense, which is funding costs. And so, unfortunately, this is what I call grandma. That number has to come down. I don't want it to come down. Surely my parents and in-laws don't want it to come down. But you're looking at, if this dropped to zero, this number would go from $700 million a quarter back down to $25 million. Well, actually probably 50 with the size of their bank and having doubled. So that $500 million goes a long way to provision and allowance. And these are set-asides for taking more charge-offs. So when rates start going down, understand part of the reason the Fed is doing it is grandma's got to subsidize big banks, especially right now, taking a lot of charge-offs and losses. The flip side to this is they're actually grandma, right? Because on the left-hand side, we see a tremendous amount of interest income on balances due, $300 million. So if we come over here and look at their total income and expense and look at their pre-tax, that number going down helps their expenses, but it also hurts their income because they're both grandma as well as a bank in this instance, right? So these losses that they're taking from charge-offs, and they're starting to take some very significant charge-offs, their income is going to be pressed because virtually whatever income they're generating now is from the Fed. It's not from the banking franchise. And as they continue to take more charge-offs and the Fed drops rates to help banks take charge-offs, Flagstar is going to be more challenged than most of the other big banks that are generating it from non-interest income, trading activities, right? All the core banking franchise that may be performing better. So, Flagstar is very much a bank that I would take a look at. Would they ever let it fail? No, I don't think they would let it fail. I think it would get merged away. But if you were to look at one bank, one big bank, and say, hey, if you were a betting man, I would put Flagstar in that probably small number of banks that just look like they're ripe for more losses. As always, I appreciate your time. If you have any questions, please reach out.